15% tax bracket. That's gone, so a lot of small corporations are going to pay more tax. Whereas on the other hand, if you're a self-employed or you have an S corporation, or if you have real estate, you may end up, if you're married, within taxable income. So remember, it's based on taxable income, which is your gross income, say your business income, your W-2s, whatever, less your itemized deductions or your standard deductions. So all the new tax laws, it's based on your taxable income, whether or not you're going to get this new 20% deduction, which probably applies to most of you in small businesses here. So if you're single and your income's under $157,000, or if you're married and your taxable income again is under $315,000, you will get this new 20% deduction. So let's say you have a small business, a small Schedule C that you file for your business, and you're married, your taxable income is under $315,000. You will take 20% of your business income, and that will be a deduction then from your taxable income. It's not a credit, but it reduces your taxable income again. So that's kind of a nice thing. But there are also what's called specialty trades. So, for example, I'm a specialty trade, Jason's a specialty trade. Specialty trades are those businesses that they feel that the business is the reputation of the owner. And they've singled out doctors, lawyers, accountants. They took in one of them. They took out their engineers. I think don't have to go on that anymore. But real estate brokers. What that means is if their income. So, for example, if my taxable income goes over $157,000, I get nothing. I get zero. Under $157,000 of taxable income, I get the 20%. Same with Jason. Jason's married. So if Jason's taxable income is over $315,000, well, actually it phases out. So it's $157,000 if you're single, and then you get less and less up to $207,000. Same with Jason. His income hits $315,000, phases out at about $340,000. Well, he'll get nothing. Those are the specialty trades. As I said, the C corporations, now the tax is 21%. That's bad in a lot of ways, but for specialty trades, so doctors, accountants, lawyers that had C corporations paid tax at 35%, regardless. They had $2,000 worth of taxable income, they multiplied that by 35%. So for those trades, this 21% is nice. There's another thing, for example, John, I know, is an S corporation. So that W-2 income, you don't get that QBI, the qualified business, that's what the new tax deduction is called. But he will get it based on his W-2. So used to be people that had S corporations, they would go into those and pay a small wage and flow through the income. Now, if their income, the flow through, so the IRS is really going to be watching people that are S corporations, because they always did anyways to make sure you were taking a reasonable salary. So now, same thing, John's married, his income goes over $315,000, he's going to have to take 50% of the wages that he's paying, and he'll still get that qualified deduction if it's that way. So there's lots of different things with this qualified business income deduction. So it's made it very difficult for us in planning. Do we keep people as a C, an S? Do we change them? They keep changing the laws. But some simple things that I want to say.
Was there something slide?
Let's see. This is gone. Let's go to the. Again, there's larger amounts of depreciation. Used to be, if you had, they called the luxury auto, a car that was worth $15,000 or more, you were in the limits. It was about $3,500 for the first year. Now it's as much as $10,000, and then you can take bonus depreciation. So they've relax the auto laws.
And I'm sorry, especially for surgery, what did you say? If you have a car over $10,000, it's a luxury car?
No, but he would be different because he probably would have business cars. Legitimately business cars. Many people have cars that aren't, like John has trucks. Those are business trucks. It's people that like who drive their cars. You can get a larger deduction now.
I was just thinking a Mercedes is a luxury car, but in the IRS,
a Ford Focus is a luxury, or a Versa.
If it hits a certain dollar range, right?
Yeah, 15,000.
Okay.
Some other things though for small businesses, there's a meals and entertainment one on there. So you used to be able to take somebody out and play golf. That's no longer allowed. You used to be able to bring meals into your office. That was a 100% deduction, if you brought it in for your employees in your office so that you could keep working. All those now are limited to 50% of the value. You can still have it used to be meals provided on the premises to the employees for the convenience of the employer. Used to be able to take 100% deduction. So people are just going to be, there's going to be a lot more office supplies, I think, this year. And when you bring your food in and things like that.
And I'm sorry, is that when Google gives free lunch to all their employees and all? They were getting tax
They
write-off?
were getting 100% tax write-off, where they had those cafeterias and all that. Now they've changed that. The only thing that you can still get 100% write-off is if you have an annual Christmas party and you invite all your employees. Those kinds of things, you can still take the 100% deduction. The other thing that everybody is, and I think it's affecting real estate a little bit in California, is the property taxes, and that's what everybody was trying to pay their property taxes early at the end of the year, or pay their last estimate early. Because if you itemize your deductions, the maximum you can take for estate income tax and property taxes together is $10,000. So, some people are paying $10,000 just for their property taxes, and that's it. They're going to just take the $10,000. But to complicate matters more, the state of California has changed nothing. So if you pay $15,000 in property taxes, you're still going to get to deduct $15,000 in property taxes. You used to be able to, let's say you're an employee and you drive your own car, or you have to buy special work boots or something like that. You get the miscellaneous itemized deductions. That is now gone. So I was thinking, yes, because people are always bringing in all this nonsense. But it's still okay for California. So we still have to continue to do everything the way we were, because California has not changed. So you still got to save all those receipts, all the same information for California, because nothing has changed there. The Spidell Publishing, which is a big California, they present seminars and stuff. They just sent out a draft of what the new California, where you show the difference between California and the federal. So I think taxes are going to be later this year, because it's going to take a while to get these new forms out. A lot of the laws are still really gray. Especially that qualified business income deduction. They keep sending us updates, and I don't know, it's just really difficult to try to properly plan and make sure everybody's getting the best deduction.
Well, that one looked interesting, but what about, does anyone here have losses?
Oh yes, losses from now. It used to be if you had an operating loss in your business, you could carry it back 2 years and then forward 20. Now all new losses can only go forward indefinitely, and you can only take 80% of that against your taxable income. You no longer can zero it out on and then the rest keeps carrying forward. So you don't lose it, it's just treated differently. Which again, I kind of like that law, because I don't ever like to amend or to open up. So if you took a loss back 2 years, that opens up the statute on that. And I just had this huge audit on losses in last December and it was a nightmare, because we had all these losses and the agent was trying to make me prove all this stuff, and I finally showed him, look, I'm very conservative. So I finally got him to go away, but it was hell for a whole month.
And I'm sorry, in a loss, a loss isn't someone didn't pay you money for a car you sold them or something. A loss is you're putting your own money into a business
or say you borrowed on credit cards. So you charge up your credit cards to go buy a bunch of stuff. A lot of people will charge their card at the end of the year so that they can, maybe buy a new truck or new computers or new things like that, and then they generate a business loss. So that business loss goes forward, and so there's all kinds of reasons that people...
So when they say buy stuff by the end of the year for taxes...
A loss is actually where your business does not show a profit.
I see.
A loss when somebody doesn't pay you something it can be a short-term capital loss. So if you loan somebody money and they don't pay you back, that's different. If somebody doesn't pay you in your business, for example, somebody doesn't pay me for my services, I'm just out. You cannot pick up something, I didn't show it as income, and you can't write it off. You're just, because how do you put a value on that? Somebody in one of those big firms maybe charges $1,000 to do the same thing that I charge $300. So you can't write off your time. Of course, you can write off the software charges and all that, but
okay.
Let's see, what else? How much? Let's see if there's anything else.
I know.
I don't know.
What about a service that you do and they never pay you?
Same thing. You're paying your employees, you're paying this, you're paying that. The only time there's two different kinds of accounting, there's cash where you recognize your income and you write off your expenses, or there's accrual basis where you pick up your receivables before you're paid. It used to be a lot there, depending on your income level, which would be in some kind of millions, you would have to use the accrual method. Now they've pushed that out. So then you would pick up all your receivables. Somebody owed you $10,000 at the end of, let's say, 2017, and in 2018 you never collected it. That's when you can write, and when it becomes a bad debt, then you write it off as a bad debt. But that's only if you showed it as income in a prior year. And that would only be, and I try never to have anybody on the accrual method, because they screw it up all the time. So it's much easier. Here's the money I got. And like I said, they've expanded used to be, I think it was like $1 million. You had to use the accrual method if your gross receipts, something like that. Now I think they put it up to 10 million or maybe even more than that. And I do have a client that they were on the accrual basis. They screwed it up so bad. I even went under audit, switched it to the cash basis, and they didn't do anything. So I just left it alone. And now they're in the limitations where it's legal. So,
and then I know some of us have children, and then there's
and one more thing is, so as you know, they've taken away the exemption. So it used to be you got either the standard deduction or itemized deductions. So the standard deductions have gone up, which 12 something for single, 24 something, or if you're over 65, you get a little bit more. So in a lot of cases, people won't be itemizing anymore on the federal. But again, the state stays the same, so you may not itemize or you may take the standard deduction now, but you used to be able to, so they raised the standard deduction, but they've taken away the exemption. So there was like a $4,100 exemption for your wife, for you, your kids, whatever. That's gone. So, but if you do have kids, that child tax credit went from $1,000 to $2,000 per child, and they raised the income limits because that used to phase out at about $180,000 or $200,000. Those are things I don't always remember because I pay about $14,000 a year for my software to remember those things, those little details. But they have raised that ceiling so that more people can get that $2,000 credit. And so that's a really nice thing because that's a credit means your income tax liability is $10,000, you get a $2,000 credit, it actually reduces your tax by $2,000.
And I'm sorry, the 2,000 is for children, or child, or no?
Child.
And is it just one, or you can do it for each kid?
Each child.
Okay.
Each child. So
Okay.
you lost the exemption for your kids, but an exemption, remember, is just a deduction. So it was a $4,100 deduction, saved you depending on your tax bracket. Whereas, so, 4,100 times 30%, maybe it saves you, I don't know, $800,000. Whereas this credit actually saves you $2,000. It actually reduces what you're going to pay the government.
Oh, that's
So-
great. A credit means
Credit
actual-
means it actually reduces tax.
Okay.
A deduction just reduces what you're going to pay tax on. So it reduces your taxable income. So a credit is always the way you want to go because it actually reduces your tax. And let's see.
Education or gift. What about like grandma or wants to give a house or money to someone?
So the gift tax is the gift that you can give anybody, $15,000 now. The new gift exemption is $15,000. Technically, if you give or gift somebody over $15,000, you're supposed to file a gift tax return. They've also changed the estate, so if somebody dies, they don't have to file an estate tax return, which is unless their income is over $11,200,000. And if they're married, then that's a combined estate of over $22 million, which is going to go up for inflation. Many of these laws are set to expire in 2025, again, making it very difficult. I do a lot of estates and trusts. So, for example, it was $5.4 million. So a lot of times they'll have different trusts and their wife will die and will fund this other trust. But now that with the new tax laws, maybe they were over the limit for the $5.5 million, but now they're under the 11. Do we make this trust go away? Are they going to live to 2025? Are they going to change those tax laws? So all of this stuff has made a lot of tax planning really hard. Everything is more complicated. When I started doing this in the 80s, I did all tax returns by hand. And now if I had to do one by hand, even a simple one, it's just something's got to change because it's ridiculous. There's so many different ways of interpreting things. And, again, if you buy, let's say you have commercial real estate, and you improve it, and you're the lessee, they've changed those laws on commercial real estate. And you know what, Jason? They've also changed some so it used to be you had to be renting commercial space, the property had to be over 3 years old, and then you could take accelerated depreciation, 15 years. Then they've changed it so you can deduct it all. But now the new laws have come out where maybe the owner of the property can take those same 15 years. So again, they just keep changing things up, making it more and more crazy.
Well, then I thought for everyone, this is an assumption, and then on this one, it's trying to explain what changes. Does this look anything of value?
So wages, personal exemptions. Yes, this is what I was talking about, the $4,100, the personal exemptions has gone away. Itemized deductions, say we're $30,000, standard deduction $24,000. This is somebody that is, and then the tax rates have gone down. So even though you see here that the taxable income is greater, the tax rates have gone down, again, depending on income. So most people are going to get some benefit from this new tax law. Where you lose something, you're going to get a benefit over here for something else. Yeah, and then as you see, here's a child tax credit. So this person must have two kids. Yes. So that's an actual deduction right off the...
What was it? Mortgage interest, charitable...
So and that's just because everything's tiered down, the tax rates.
And then mortgage interest, or what was?
Okay, so that's another thing. So if you have mortgage it used to be we could take mortgage interest qualified, everybody's mortgage interest was qualified, right? Which means it was either to buy, build, or improve your home. So they used to be able to take that plus an extra $100,000 that you could go buy a car, buy whatever, pay off credit card debt. So we would say that the limit on mortgage interest was $1.1 million. Starting in 2018, that extra $100,000 for anything you want has gone away. So you can deduct mortgage interest up to $100 million. So what that means is if you've got $1.2 million mortgage on your home, you have to take a fraction, the million over the $1.2 million times your mortgage interest. You don't get to write the whole thing off. But those are grandfathered if you owed that 2017 before. Starting in 2018, anyone that gets a new mortgage, all you can write off mortgage interest to is $750,000. So that again, I think is starting to slow down our bigger home sales here in California, because somebody needs to go get a $900,000 mortgage. They can only write off the interest up to $750,000. So the mortgage interest is limited, and then on a $900,000 home, your property tax is going to be way over the $10,000. So that is limited. Not on California though. California, remember, has not conformed to any of these laws. But we don't pay as much tax. California's highest tax rate is only about 10%. So it's not that big of a deal. And there was one other thing, something else I was going to say along those lines. So you want to be really careful if you're refinancing and things like that your mortgage stays if you do have one of those $1 million loans. The other thing is if you get alimony, new thing, if you were not divorced by the end of 17, or is it 18? Anyways, alimony is no longer deductible. So you don't even want to modify your existing order if you have one. So if you're paying alimony, you used to be able to deduct it off your taxes, and then the receiving person would have to pick it up. I can't believe that's for divorces. You have to be divorced by the end of 2018. 2018, you still fall into that window. I cannot believe that's not going to go away, because what's going to happen is the spousal support is going to have to be lowered, because how is that fair that somebody's paying $50,000 in alimony or $30 or whatever? But this again is grandfathered. If you were divorced before 12/31 of 18, you still get the old rules. That's
really
kind
of well, one thing like an insurance money, or if you go to the casino and win money, or like when you there's certain money that you don't have to tax, right? Or no, well, insurance money, right? If your car got totaled,
right,
or a settlement from a lawsuit.
It depends. Let's say that you're right. If it's personal, you're not deducting your insurance on your car. So remember, for something to be taxable, it had to be a write-off to begin with.
And I'm so sorry. I meant like if your car got in an accident and you got a payout from the insurance company, that's not taxable money, is it? No. So types of money.
But again, on the other hand, if let's say you file a lawsuit and you are suing somebody like your employer for loss of wages, this and that and the other thing. The unfortunate thing is, and I do a lot of these 1099s for this attorney, and it just makes me crazy, because let's say you get an award of $100,000, but $40,000 of that goes to your attorney. Used to be you'd pick up that $100,000, and then you could, on those miscellaneous itemized deductions, write that $40,000 off. There are no longer miscellaneous itemized deductions allowed. So you're going to pick up that whole $100,000 and pay the tax on it without any offsetting deduction at all anymore. Even with the miscellaneous itemized deduction, that was a limited deduction, but at least you got something. So that's one of the new things in the tax laws. So all people that are suing need to be careful, because you think you're $100,000 less $40,000 that you're paying the attorney, paying tax on $100,000, you might not come up with very much money. So maybe it'll stop some of the frivolous lawsuits. I don't know.
Well,
So,
well, thank
am I done?
no,
Any
well, with that
questions?
being said, I know it's past 8:30, but even if people do their own taxes, I guess TurboTax tries to keep up to date. But this tax year is critical to maybe talk to, even if it's not you, a tax person.
be.
I mean, this.
I'm sure if you have a small business, you do TurboTax, it's going to fit in. I'm sure they're reprogramming their stuff, and they're going to take your business income, they're going to multiply it by the 20%, and their software. So, like I said again, the softwares are all being redone. So I have a feeling that this is going to be a late file. You know, it's like with the IRS, we're probably not even going to be able to file anything until the end of February. Usually it's the second week of February. Then everything changes. So, and that's another thing. They give us about a month, because people that use a CPA, they don't get all their stuff till the middle of March practically. So it gives us like a month to do it's insane. And so they really should open up that window. It's made it really difficult, but no, all those softwares work really well. I know TurboTax is made by Intuit, which makes QuickBooks, which makes the Lacert software that I use. So I know they've put a lot of money into that to make it
Okay.
what it is. Okay.
Well, thank you, Pam Dose,
Questions? Feel free.
CPA. All right, thank you.
Sorry I didn't use your slide.
See ya.